In this video, we are going to focus on depreciation for assets that were purchased during the financial year. We are going to do straight line method questions and the carrying value method questions. So we are going to start with the straight line method, also known as the cost method, and we are going to look at how do we deal with an asset that has been purchased during the year using this method. So as you all know, that the formula for depreciation when it comes to the cost method, we have depreciation is equals to original cost. We said in the last part, if you have missed it, go watch it, that the original cost here, we are talking about the purchase price. Whatever the purchase price was when you purchased the asset, that is what we are talking about when we are talking about a purchase price. And then it is multiplied by rate, which is the percentage. The percentage, you will find it in your adjustment. It should be given to you in your adjustment. And then we are talking about M, which is the number of months in which you have your asset in your possession. So in the previous activity that we did, in the previous lesson that we did, the assets were had by the company for a full 12 months of the year. So we never had to really worry about the number of months in which we had the asset in our possession. But now that we are dealing with an asset that has been purchased during the year, this M is not going to be a 12, because it means that we did not have that asset at the beginning of the year. We only purchased this asset at the beginning of the year, so somewhere along the year. So we are dealing with less than 12 months, and that's why this M becomes important. So now that we have cleared that up, let's go ahead and look at an example. Your example reads, you have company B that purchased a vehicle on 31st August 2023 for 200,000 rands. The company depreciates vehicles at 15% per annum on cost. That on cost is the one that is telling us which method are we using. And then it says, for your question, calculate the depreciation for the financial year ended 28 February 2024. So you will notice that because our asset was purchased at 31st August 2023, it means that it was purchased during the year, because if our year is ending on the 28th of February 2024, it means it started on 1 March 2023. So when you are doing this question, it will be very important for you to write down the timeline of your accounting period. When they tell you that it ended 28 February, you count 12 months down and figure out on which month did it start. So this one will be 1 March 2023 to 28 February 2024. So now that we have our financial year down, you will count how many months of this financial period did I have my asset on hand, or the asset in our possession in the company. So you had your asset from the 31st of August 2023, so you start counting the months, only the months that you had this asset in your possession. So before the 31st of August, you did not have this asset in your possession. So you want the number of months to be specific in which you had this asset in your possession in this current year. So that talks about our M. So the first thing to figure out here is our M. So we are looking for that M. It's counted from September. Why September? You also have to pay attention to the day. It says that the asset was purchased on 31st August. That is the end of that month, so we cannot count the month of August. So it means that we are starting to count from September. So we are talking about September, October, November, December, January, February. So that is 6 months. You had this asset for 6 months. So your M becomes 6. And then for all your other parameters, your original cost, they have told us that it is 200,000, and our rate is 15%. So now that we have everything, we can now go on and plug into our formula. So depreciation is equals to 200,000. This is our original cost, which is our purchase price, multiplied by rate is 15%, that is 15 over 100, multiplied by now M is 6 months of the full 12 months, and then you will have your depreciation for the year. You punch this whole thing into your calculator as it is, and it will give you 15,000 rands as your depreciation for the 28 February 2024 financial year. Now, for the carrying value method, also known as the diminishing balance method, we know our formula to be depreciation is equals to carrying value multiplied by rate multiplied by M over 12. So when we are talking about carrying value, you will remember we said carrying value has a formula. The formula is original cost, and you will subtract accumulated depreciation. So before you do anything else with the carrying value method, what you have to do is calculate your carrying value, which is the original cost minus the accumulated depreciation, and your rate will always be that percentage that will be given to you in the adjustment, and M is the number of months in which you had the asset in your possession, especially in this case of us purchasing an asset during the financial year. So you want to pay attention to this M as well, and also make sure that you have the correct carrying value. Now let's go to an example. Your example reads, Company B also purchased a new office equipment on 1 January 2024 for 60,000 rands. Depreciation on equipment is calculated at 10% per annum on carrying value. So the on carrying value tells you that we are using the carrying value method or the diminishing balance method. And lastly, they want you to calculate depreciation for the financial year ended 28 February 2024. So again, we are dealing with an issue of purchasing the assets during the financial year. The timeline of your financial year becomes important. So the year ended 28 February 2024, which means it started 1 March 2023. Our asset in this case was purchased on the 1st of January 2024. So this tells you that when they purchased this asset, our year was only left with 2 months, meaning that in our possession we had this asset for only 2 months, which gives us that M. So M in this case becomes 2. And then we go on to the rate, which is 10% per annum, so 10 over 100. And then we know that we need now our carrying value. Carrying value, again, we said that it has a formula: original cost minus accumulated depreciation. The original cost is the purchase price, so we purchased our assets for 60,000 rand. Now, accumulated depreciation, if you remember well in the previous video when we talked about accumulated depreciation, we said it is the depreciation of all the other years before this current year. So every other year from the date that you purchase the asset up until now, that's the depreciations of the other years, of the past years added together. But in this scenario, our asset is new. It was only purchased on the 1st of January 2024. In meaning there's no any other year before this year. There's no any other year before this date. It did not exist before this date. What does that mean? It means that our accumulated depreciation is 0. So for CV carrying value, when you say original cost, what are you minusing in the place of accumulated depreciation? You are minusing 0, which means that for new asset, most commonly your carrying value will be the same as the original cost. But it is not to say that carrying value is original cost. No, its carrying value is original cost minus accumulated depreciation. It just so happened that with new asset, the accumulated depreciation will always be 0 because this asset did not exist before this year. So our carrying value is 60,000 rands. So now that we have everything that we need to calculate depreciation, we can go and plug into our formula. Carrying value we have established, it's 60,000 rands. Our rate is 10% per annum, so 10 over 100. And our M is 2 because we only had this asset in our possession for 2 months, which means that our depreciation for this year is 1,000 rands. Now that we have dealt with assets that were purchased during the year, in the next video we are going to deal with depreciation for assets that were sold during the financial year. And in the video after that, we are going to do with exam paper questions. Remember, depreciation is part of the statement of comprehensive income that falls in paper 1. So in that video, we will focus on paper 1 questions that have to do with depreciation for both the diminishing balance method and the cost method for all types of transactions. Assets we've had for a full accounting period, assets that were purchased during the year, and assets that were sold during the year.